You know, right now, everyday consumers are moving just billions of dollars out of traditional bank accounts. I mean, everyone is chasing those 4 and 5% yields in treasury bills and money market funds.
Oh, absolutely. The hunt for yield is relentless right now.
Right. That's all anyone talks about. Yet somehow a regional bank in California has managed to convince businesses to leave billions of dollars sitting in accounts that pay absolutely zero interest.
Yeah, it's pretty wild when you think about it.
It really is. So today we are taking a deep dive into the second quarter 2026 earnings report and the supplemental financial presentation for Hanmi Financial Corporation. They're the parent company of Hanmi Bank.
And this is a really fascinating one to dig into.
For sure. The mission here is to look past the surface level numbers. We want to decode the actual financial mechanics of how a regional bank thrives in this complex higher rate environment we're in.
Yeah, because the broader market narrative right now suggests that regional banks are under immense pressure, right? They're caught between rising deposit costs and, the constant fear of commercial loan defaults.
Exactly.
But when you actually look at the data coming out of Hanmi's Q2 report, it paints a very different, highly specific picture of asset liability management. I mean, they're executing a balancing act that challenges a lot of assumptions about where the banking sector is headed in the back half of 2026.
Well, let's start by looking at the headline profitability. So for the second quarter, Hanmi reported net income of $23.5 million,
Right.
which is a 4.2% increase from the first quarter. And diluted earnings per share came in at 79 cents.
Yeah, solid numbers.
Definitely. But the metrics that really stand out to financial analysts are the efficiency ratios. They posted a return on average assets, or ROAA, of 1.20%, and a return on average equity of 11.09%.
Which is huge.
Right. So for you listening, if you're accustomed to looking at these benchmarks, how should you interpret a 1.2% ROAA in the current macroeconomic climate?
Well, historically, a 1.00% ROAA has been like the gold standard for a well-run, highly efficient regional bank.
A holy grail, basically.
Exactly. So pushing that metric to 1.2% in a quarter where funding costs are just notoriously elevated across the industry, it indicates significant operational leverage.
Meaning they aren't just growing for the sake of growing.
Right, exactly. Management isn't just expanding the balance sheet to look bigger. They are highly disciplined about the profitability of every single dollar sitting on that balance sheet.
And that ROAE number.
Yeah, a return on average equity over 11% further demonstrates that they're generating strong returns on the actual capital provided by shareholders. And they're doing it without over-leveraging the institution.
Anyway, let's unpack this a bit more. That efficiency is inherently tied to their net interest margin, which came in at 3.36%.
Right, the N.
Yeah, the NM. We know that's the core driver of a bank's revenue, the spread between funding costs and asset yields. It's basically a retail store's markup.
That's a good way to look at it.
And total net interest income for Hanmi actually increased by a full 1.0% to $63.9 million for the quarter.
Yeah, it did.
But here is the tension, right? Interest rates have been volatile, and depositors are demanding higher yields. So how did Hanmi manage to expand their net interest income sequentially when the cost of retaining deposits is squeezing margins at, like so many other institutions?
Well, if we connect this to the bigger picture, the expansion of that net interest income is the result of optimizing both sides of the balance sheet at the exact same time.
Okay.
So on the asset side, they are realizing higher yields from their commercial real estate and commercial and industrial lending portfolios. The loans they're making are simply generating more cash.
Right.
But the critical differentiator is on the liability side. They improve their funding mix by actively reducing their reliance on expensive wholesale borrowings, and they shifted that weight toward lower cost deposits.
So they essentially lowered their weighted average cost of capital while increasing their asset yield.
Precisely. Which brings us directly to those deposit numbers.
Oh, man. Which are arguably the most surprising part of this entire earnings report.
Completely agree.
So total deposits grew 2.3% sequentially to $7.0 billion. But the specific breakdown is where the real story is. Non-interest-bearing demand deposits increased 5.2% sequentially.
Yeah, 5.2% growth in free money.
Right. These free deposits now make up 31% of the bank's total deposits, up from 30% in Q1. And their overall total cost of deposits was maintained at just 2.25%.
I mean, 31% of a $7 billion deposit base yielding 0% for the depositor is just a massive competitive advantage. It gives the bank this incredibly cheap pool of capital to deploy.
I have to push back on the logic of this from the depositor's perspective, though.
Okay, go for it.
We just noted at the top of the show that we are living in a high-yield era. Anyone with significant capital is acutely aware of what Treasury bills or high-yield accounts are paying.
Oh, absolutely.
So why would anyone, let alone businesses with, sophisticated treasuries, leave 31% of their cash in an account that pays zero interest? It just seems completely counterintuitive to basic financial management.
Yeah, it seems counterintuitive until you look at the specific client base that Hanmi targets.
Okay, explain that.
So CEO Bonnie Lee's commentary heavily emphasizes their relationship-based banking model. The depositors leaving millions in zero-interest accounts, they're not retail consumers trying to maximize their personal savings.
Right, they aren't logging into an app looking for an extra 0.5%.
Exactly. They are mid-sized commercial enterprises. A corporate treasurer looks at these operating accounts completely differently than a retail investor looks at a savings account.
So they are prioritizing something other than yield.
They are prioritizing absolute liquidity and operational reliability. Think of a commercial operating account like the plumbing of a large building.
Ah.
You don't try to earn interest on the water sitting in your pipes, right?
Right, right.
You just need the pressure to be there the exact second you turn on the faucet. These businesses need that capital to be highly liquid to make payroll, process vendor payments, manage inventory on a daily basis.
And Hanmi facilitates that.
Exactly. Hanmi provides specialized services, trade finance, complex treasury management, specific SBA lending that integrate deeply into these companies' daily operations. Because the bank serves as the critical financial infrastructure for the business, those deposits stay put.
Wow. Okay, so the service value far outweighs the opportunity cost of the lost yield.
You nailed it.
That makes perfect sense. The stickiness of the deposits is a byproduct of operational integration.
Right.
And having secured this pool of cheap capital again, with an average cost of 2.25%, the next logical step is looking at how they are deploying it onto the road to generate returns.
Yeah, let's look at the loans.
Looking at their loan production for the second quarter, they originated $371.9 million in new loans, and the average rate on that new production was 6.59%.
And to understand the immediate impact on profitability here, we have to contrast that new production rate against the loans that were paid off or matured during the quarter.
Okay, the runoff.
Right. Hanmi saw $156.4 million in loan payoffs, and those outgoing loans carried an average rate of 6.39%.
Here's where it gets really interesting. So they are letting 6.39% loans roll off the books and replacing them with 6.59% loans.
It is functionally similar to a commercial landlord managing an apartment building.
Oh, I like this analogy.
Right. So if you have older tenants moving out who are locked into leases at a lower rent in this case, the 6.39% loans, you take that opportunity to move new tenants in at the current higher market rate of 6.59%.
The building itself hasn't changed.
Exactly. The building is the same, but the aggregate cash flow generated by the property instantly increases. Hanmi is utilizing the natural churn of their loan portfolio to steadily walk up the overall yield of their asset base.
And that expands the net.
Right. When you combine that rising asset yield with the flat, low-cost deposit base we just discussed, the inevitable mathematical result is the widening net interest margin they reported.
Well, let's break down exactly where that $371.9 million in new production is being allocated. Commercial real estate, or CRE, was by far the largest category.
Yeah, that's their bread and butter.
Right. They took in $170.1 million there. Then commercial and industrial loans accounted for $89.2 million. Residential mortgages sat at $50 million.
And then the SBA loans.
Yeah, SBA loans came in at $37.1 million, and equipment finance rounded it out at $25.5 million.
And, the heavy concentration in commercial real estate, which represents nearly half of their new loan production, is really the data point that requires the most scrutiny.
It definitely raises a flag regarding risk management. I mean, if a bank is actively replacing older loans with new ones at these higher interest rates, pushing the cost of capital for a commercial borrower to 6.59% or higher, doesn't that inherently compress the borrower's operating margin?
Oh, without a doubt.
It seems like aggressively originating higher rate CRE loans right now would dramatically increase the probability of default, especially given the broader anxieties surrounding commercial property valuations.
Well, that's the paradox of banking in a higher rate environment, right? The very mechanism that drives record net interest income is the exact same mechanism that tests the solvency of the borrower.
Because the debt is just so much more expensive to service.
Exactly. Higher rates mean higher profits for the bank, but only if the borrower can sustain the payments. The moment the borrower defaults, the asset becomes a liability. And as you mentioned, the mainstream financial press has been heavily focused on a potential doom loop in commercial real estate.
Right, citing high vacancy rates and declining property values.
Exactly.
But the asset quality metrics in Hanmi's Q2 report completely contradict that broader doom loop narrative. I mean, despite the heavy CRE concentration and the higher rates, their asset quality actually improved during the quarter.
What's fascinating here is just how much it improved.
Right. Non-performing assets. The loans that are seriously delinquent or in default dropped by 20.2% down to just $9.9 million.
And putting that $9.9 million into context really highlights the strength of their balance sheet. Hanmi manages roughly $8 billion in total assets.
So $9.9 million is basically a rounding error.
Exactly. A non-performing asset level of $9.9 million represents a mere 0.12% of total assets. Furthermore, their non-performing loans sit at just 0.15% of total loans.
Wow.
Yeah, these are exceptionally low distress levels for any economic environment, let alone one characterized by elevated interest rates and commercial real estate headwinds.
We also saw their credit loss expense fall significantly. It dropped to $1.2 million from $2.9 million in the first quarter.
It's a pretty dramatic drop.
Yeah, their actual net charge-offs, the loans they formerly recognized as uncollectible losses were only $1.3 million, and the supplemental data indicates those were mostly isolated to their equipment financing segment, not the CRE portfolio.
Right. And the lack of distress in their CRE portfolio points to the localized reality of commercial real estate versus the national headline narrative.
What do you mean by that?
Well, not all CRE is created equal.
Right.
A Class A office building in a hollowed-out downtown corridor carries a vastly different risk profile than, say, a multifamily property or a specialized industrial warehouse or a neighborhood retail center anchored by essential services.
Oh, that makes sense. The doom loop isn't hitting every property type evenly.
Exactly. And Hanmi's low default rates validate CEO Bonnie Lee's statements regarding their prudent underwriting standards. They are clearly structuring these loans with sufficient equity buffers and debt service coverage ratios to absorb the higher interest costs.
And they're also maintaining a massive shock absorber just in case those macroeconomic headwinds do eventually materialize.
The allowance for credit losses.
Yes. Their allowance remains robust at $70.5 million. That represents 1.08% of their total loan portfolio.
And the psychological stance of management is very clear when you juxtapose those two numbers.
Oh, so?
Well, they are holding a reserve that covers 1.08% of their loans, while their actual non-performing loans are sitting at just 0.15%.
Ah, I see.
Yeah, they are heavily over-reserved relative to their current realized stress. This conservative posture allows them to aggressively originate new loans at higher yields because they know they have built a fortress balance sheet capable of absorbing unexpected shocks without impairing their core capital.
Which naturally leads us to capital allocation.
Yeah.
So what does this all mean? When a bank expands its net interest margin, maintains exceptionally low deposit costs, and experiences negligible loan defaults, it generates a significant amount of excess cash.
A lot of excess cash.
Right. And how Hanmi chooses to deploy that profit tells us a lot about their confidence in the future. In the second quarter, they returned 58% of their net earnings directly to shareholders.
Returning more than half of quarterly earnings is a highly aggressive payout ratio for a bank of this size.
It really is.
They executed this through a dual mandate. They paid out $8.3 million in cash dividends, which represents 28 cents per share, and they simultaneously repurchased $5.2 million of their own common stock on the open market.
Generating the internal capital required to fund a 58% payout ratio while simultaneously growing the fundamental value of the enterprise. I mean, that is a difficult needle to thread.
Oh, very difficult.
Yet their tangible book value per share, basically the core liquidation value of the bank, excluding intangible assets, grew by 1.8% to $27.04. And their capital ratio, tangible common equity to tangible assets, remained incredibly healthy at 10.03%.
It just demonstrates the power of compounded retained earnings when credit costs are minimized. Even after handing back $13.5 million to investors, the remaining 42% of their net income was sufficient to organically accrete book value.
Right, and maintain their capital ratios well above the regulatory minimum.
Exactly. It provides management with a tremendous amount of strategic flexibility heading into the second half of the year.
Now, to be fully comprehensive, there was a minor headwind detailed in the earnings report.
Yeah, on the non-interest income side.
Right. Non-interest income, the revenue generated from fees and activities outside of traditional spread lending, dipped slightly by 2.2% to $8.3 million for the quarter. The supplemental data attributed this primarily to a $0.8 million decrease in the gain on the sale of SBA loans.
Yeah, and the mechanics of SBA lending involve banks originating the loans and frequently selling the guaranteed portion into the secondary market at a premium.
Okay.
That premium fluctuates based on broader market liquidity and investor demand for those specific government-backed assets. In the second quarter, the premiums Hanmi commanded on those sales just tightened slightly compared to Q1, which resulted in the minor revenue dip.
Got it.
However, within the context of a quarter where core net interest income grew substantially, a sub-$1 million fluctuation in secondary market premiums is largely immaterial to the overall earnings trajectory.
Yeah, that makes sense. Looking forward, the commentary from management remains highly optimistic. CEO Bonnie Lee explicitly stated her confidence in continued earnings growth for the second half of 2026.
And she pointed to robust pipelines for both loan originations and relationship-based deposits.
Right. The underlying fundamentals that drove this quarter's outperformance appear to be deeply entrenched in their operating model.
The data definitely supports that optimism. Hanmi has demonstrated a real mastery of banking fundamentals in this specific environment. I mean, they are acquiring capital at an incredibly low blended cost. By leaning into corporate operating accounts, they're systematically churning their loan book to capture higher market yields, and they're avoiding the credit pitfalls that are currently plaguing less disciplined lenders.
So as we wrap up this analysis, Hanmi Bank clearly had a stellar Q2 2026. But if there is one structural tension for you to monitor as we move through the rest of the year, it really centers on that loan production breakdown.
Yeah, the CRE concentration.
Exactly. Hanmi aggressively deployed $170.1 million into new commercial real estate loans this quarter alone, almost half their new loan production.
Right. And the current credit metrics prove they have mastered their specific underwriting niche today. But, the definitive stress test lies ahead.
What do you think that looks like?
Well, if we see a delayed structural repricing in the broader commercial property sector, a scenario where valuations drop significantly regardless of local market dynamics, the question will be whether Hanmi's disciplined approach and heavy allowance reserves are robust enough to shield them.
Right.
That heavy concentration in CRE will ultimately dictate the resilience of their balance sheet if the macroeconomic environment abruptly deteriorates later in 2026 or beyond.
It is the ultimate test of their risk management framework and something we will be tracking very closely in future earnings cycles. For those of you looking to stay ahead of the curve on corporate earnings and structural financial analysis, make sure to follow the show for daily earnings coverage. Thanks for joining us on this deep dive.